Okay, these are a few words about the Cradle Ltd example from, I don't know what text this is from. Okay, cash, no-brainer. Receivables. Let's talk about, we've got carrying amount of 815,000. Now, think about what the carrying amount of accounts receivable actually consists of. Accounts receivable are the raw amount in accounts receivable less the allowance for doubtful debts. Now, allowance for doubtful debts is created by going debit doubtful debts expense, credit allowance for doubtful debts. However, tax rules don't like estimates, and that's an estimated expense. So that journal entry, debit allowance for doubtful debts, debit doubtful debts expense, credit allowance for doubtful debts, cannot be done for tax purposes. So if you're considering comparing the accounting records with the tax records, you'll find that the accounting records, the carrying amount for accounting, will be lower than the tax base because of the allowance for doubtful debts that exist. Yes, and we see there's an allowance for doubtful debts of 70,000. So, to be honest, this whole taxable amount, deductible amount stuff is crap, and I try to get people to avoid it. There is a meaning to it. So let's just firstly talk about the carrying amount and the tax base. The carrying amount for accounting is the raw amount less the allowance. For tax, you can't create the allowance because you're not allowed to count the expense until the debt actually gets written off, in which case it goes straight against accounts receivable in a future year. So there is no allowance for tax. Therefore, the allowance for doubtful debts doesn't exist for tax, and accounts receivable is sitting there at its raw amount of 885,000. Now, if you want to understand the taxable amount and the deductible amount columns, I don't think it adds a lot to your understanding of the issue, but a deductible amount is essentially going to be an additional amount. I'm always bad at explaining this. It's an amount that has been treated as an expense for accounting, but will be treated as an expense for tax at some stage in future. Therefore, the amount hanging around is a potential deduction, but in future when tax rules allow you to deduct it. So that's what the deductible amount is. Inventory is the same. Prepaid insurance. Now, this is why I hate questions like this. We don't know how prepaid insurance is treated. There's some assumption here, and this text sucks. The only things I can ever guarantee for you is that certain expenses are only allowed to be deducted when you have strong evidence for tax. And those are doubtful debts. For accounting, it's an expense when you estimate it. For tax, it's a deduction when you get, a letter from your debtor from Brazil saying, nah, I'm not paying. Provision for warranties, provision for long service leave, provision for holiday pay. You do the estimate for accounting, based on when you think the expense was incurred, but because tax doesn't like the estimated expenses, it won't allow you to claim the expense, in other words, create the expense and therefore create the provision, until you actually pay it. And when you pay it, of course, you don't need a provision. It goes straight against cash. So we don't know about prepaid insurance. Now, what they seem to be assuming in this question, what's not clear to me here, is that we have got prepaid insurance as an asset for accounting, but there's no prepaid insurance as an asset for tax. So what this suggests to me is that the company has treated insurance as an expense when it paid it, even though it hasn't yet been used for accounting. Now, you're allowed to do that. Tax rules allow you to make that choice, but you don't have to make that choice. If you want to, you can treat it as an asset and treat it as an expense when it's used. Australian tax law gives you a choice between accrual and cash. So what they're assuming here is that the company treated prepaid insurance as an expense for tax purposes as soon as it was paid. Well, okay, credit cash, the debit's either going to go to an asset called prepaid insurance or insurance expense. For accounting, it's gone to the asset, prepaid insurance. For tax, it's gone to the expense, therefore there's no asset there. Does that give you a rough idea of how it works? I could go through all the others in detail, but I think that gives you a flavour. The other's really complicated. Long service leave I've talked about, right? You can only create the provision with an estimated expense. You're not allowed to do that for tax. Therefore, the provision will exist for accounting, but of course it won't exist for tax purposes because you can't do the estimated expense. So if you can't do the debit, there can't be a credit there. Does that help?